retail sales data just around the corner. Your bond market shaping up as follows. 2s, 10s and 30s. Bond yields look like this. Yields higher by a single basis point on 10s, up 2 or 3 on 2s. With your data, let's cross over to Bloomberg's Enda Curran. Hey, Enda.
Good morning, John. Just waiting for the retail sales numbers here. The headline number is up 1.7% to 1.4%. That, of course, likely reflects a big increase in gas prices. If you look at the sales, ex-autos rising 1.9 to 1.4%, and the control group is up 0.7% to 0.2. So just going through the numbers, John, the control group is the one that we look at because the headline number is impacted by higher gas prices. And of course, we know car sales have been stronger. So it's getting a sort of skewed effect because of what happened in the month of March. But that control group, which strips out gas prices and cars and the like, that increasing there 0.7% above expectations, hinting perhaps at some of residual strength from the tax refunds. And of course, higher income consumers also keeping things ticking over there. So better than estimated for sure, but also likely reflecting some one-off impacts due to the tax refunds. So kind of a mixed story, I would say, in the retail sales number so far.
So far, so good, though. If you put it all together, the totality of the data, a surprise to the upside. Resilience, I'd go one step further than that. That's a decent upside surprise. Control group coming in at 0.7, the estimate 0.2. Equity futures holding on to gains, higher by a third of 1% on the S&P, up by 0.4 on the Nasdaq. If you turn to the bond market, yields were higher by some 2 to 3 basis points, now 3 to 4 on the front end of the curve. 2's at 375.81, up 2 now. So an additional basis point higher on a 10-year to 4.2727. That, together with other data points as well, Lisa, over the last several weeks, the data has been better than expected stateside.
Yeah, we've seen incredible amounts of surprises to the upside in terms of economic data. And it wasn't just that the actual headline numbers came in higher than expected. The actual previous months were revised upwards. So you're getting not only a sense that this past month, as we did see gasoline prices increase, you saw retail sales increase, but it actually was off of an even warmer retail sales the previous month. Look, all of this just points to the idea that you're getting upside surprises in an economy that is supposedly being slowed down by higher oil prices. Those messages are uncomfortable to put together and just highlight how difficult it's going to be for the Federal Reserve to justify cutting rates at a moment with inflation and, frankly, evidence of strength in the economy.
Headline, month over month, coming in at 1.7%. The estimate was 1.4. If you strip out autos and gas, that comes in at 0.6%. The estimate was still 0.3, so it's an upside surprise. The retail sales control group, important factor, gets plugged into GDP, comes in at 0.7%. That's an upside surprise relative to an estimate of 0.2. And as you pointed out, Bramo, better reads for the month before as well, almost across the board.
This points to strength, especially given the fact that when you strip out autos and gas, you still see that better than expected retail sales component. It also speaks to what we hear from a lot of different executives on corporate calls. We hear about how the consumer is still strong and still spending, and that's the reason why you're getting these upside beats. So maybe the less you know, or maybe this is what we have to take away from what we're getting from all of the earnings, which is better than expected U.S. economy that's able to weather this particular oil crisis.